Diane King Hall, host of Morning Movers, is with me, taking a look at Docusign this morning, also down 17%.
Yes. Getting hit hard, not participating in the gains that we're seeing in the broader market for Docusign, even though it did beat expectations for the trailing quarter. But it's all about guidance, especially as we get towards the end of earnings season. And it's not so much about its overall guidance, it's about what the expectations are for future billings growth, that coming in weaker than expected. I'll give you the numbers on the trailing quarter. They reported for the first quarter adjusted earnings per share of 90 cents a share. That beat the Street's estimate. Street was looking for 81 cents a share. Revenue coming in at $763.7 million. That beat expectations. Street was looking for a little more than $748.1 million. So they beat on both the top and bottom line. But here's where the worry is. Their full year billings guidance, that was lower. Their new range, they're projecting that to come in between $3.28 billion to $3.39 billion. That is below the prior range that they had expected, between 3.3 to 3.35, around there. So that's triggering some significant market concern here. Now, their forecast for this current quarter is ahead of estimates, but again, it's that growth trajectory that really has Wall Street worried today. For the second quarter, just to catch people up on this, they're projecting their revenue forecast is to come in a range of between 777 and 781 million. So that would obviously be incrementally higher from the first quarter here, and that is ahead of estimates. For the second quarter, they're projecting subscription revenue to come in between 760 to 764 million, and their billings guidance to come in between 757 and 767 million. They talked again about AI integration and innovation there, including their enhancing the identity and access management platform, deepening integration with Salesforce. But again, really, I mean, you are seeing the stock get hit hard, and now it takes it significantly lower for the year. It's taking away its gains for the year.
Yeah, I mean, the weak billings overshadowing the growth strategy, and the growth strategy has been a good one. I mean, we've seen some real bright spots for Docusign. Yeah. It went from $48 up to $107 at one point this year. So it really has had an incredible run and has been on somewhat of an uptrend, but today's news here really weighing, and I see some of the price target cuts today.
Yeah, absolutely. There are several analysts who are cutting, great point, several analysts who are cutting their price targets today. You have Wedbush cutting their price target to $85 a share. They are neutral. They're maintaining that neutral rating on Docusign. Needham reiterating a hold on Docusign. Morgan Stanley lowering their price target to $86 a share from 92. That signals some small upside from here. They're equal weight, so also neutral on this. UBS neutral as well. They are lowering their price target to $80 a share from $85 a share. So again, a lot of analyst activity around this one, especially again about the growth story here. They are profitable, obviously. They generate strong cash flow, but this billings number is not at all what the Street had expected, Nicole.
And next up, we have McDonald's. McDonald's is relatively flat, has been a winner year to date. It squeezed out a 6% gain, so I think shareholders will take that. What's the news today?
So Loop Capital is downgrading this one, but it's not moving the needle really, as you mentioned, with regard to shares. They're downgrading it to a hold from a buy. They cite concerns about just sales momentum. They talk a little bit about one of their new offerings and just the reception of that, and that's one of their concerns here. They've lowered their price target to $315 a share from $346. So they're just reflecting muted expectations for this year. They're less confident that McDonald's can meaningfully boost domestic same-store sales, which we did see weakness recently when they reported those numbers. They talk, one of their biggest concerns is just the new chicken strips and the reception of that. They don't think that it's going as well as McDonald's expected, and McDonald's was looking for that to be a catalyst, especially when you think about the snack wrap and that relaunch there. McDonald's has been counting on that to drive sales. Their optimism before for Loop Capital, that was tied to this, kind of menu changes. Now, look, McDonald's is facing a challenging environment where consumers are looking for value, and then there's obviously competition. And then McDonald's had that weakness in comps recently. You recall, Nicole, they had that 1% drop in global comps, and they had that big decline in U.S. comps.
And folks have to get out there and spend. This is a sort of a lower price point that folks can do that, right? I mean,
yes.
Right? Generally,
yes, but it is higher than it used. And some argue that it's comparable to fast casual now. So if people are making that choice, they might go with a fast casual option versus fast food because the price point is becoming about the same now. McDonald's trying to lead into value with some of its offerings. But again, now to be fair, we're seeing the stock move little on this. Part of that reason may be, one, if there are value conscious consumers. Some analysts obviously still see McDonald's as a winner, and McDonald's has been slightly outperforming the S&P 500 year to date. And at the same time, Loop Capital recently, like just a few weeks ago, Nicole, had maintained their buy rating. So they've just changed their tune a few weeks later.
And people are doing more grocery shopping too. I mean, we've seen the grocery aspect for, Walmart and Costco and all these other names.
That's the competition.
They're doing some more of the grocery shopping at home. As we talk about Urban Outfitters, which is down, you're going to give us the whole story. It's been a winner in the group of retailers. And I'll just add in, folks, I just had an eye-popping moment while Diane was speaking. Rent the Runway is up 25%.
Oh, I
today.
missed that one.
I missed it too. It came across on the Thinkorswim wires, which I think is really interesting, better than expected results. So you are seeing some retailers doing very well and others not so much. What's the Urban Outfitters story
So
today?
the Urban Outfitters story today, it's upgraded over at Jefferies. It's upgraded to a hold from underperforming. You're right. Look, Urban Outfitters has been a winner year to date. Initially was indicated higher in the pre-market, but it's up more than 20% year to date. So today, right now, it's down a little bit, off a little more than 1%. What Jefferies sees from here is a more balanced risk-reward outlook. They've got a new price target. They have increased. It is up from, they had previously saw it at $50 a share. Their new price target is $70 a share. So that is a significant increase from where they saw Urban Outfitters, and does signal a little bit more upside from here, not much, so hence the neutral rating. Their upgrade following those strong first quarter results from Urban Outfitters, optimism heading into their upcoming investor events. They like some of this segment performance that we've seen. We know they've got strength in Anthropologie, Free People, Nuuly, and even their namesake brand did better than expected in the most recent quarter, and that's been one of the challenge pieces of Urban Outfitters. There's always been, or for some time now, the strength in Free People and Anthropologie, but for Urban itself, the namesake brand, to gain some market share, that's something that's notable. They are keeping a watch on inventory levels. They're not shocked by that. They don't see it as problematic for now. Inventory is up 15% year over year. That's a little bit ahead of what their sales growth is, but again, they're not worried about that. They're only worried, they do see some risk to be mindful of when it comes to investor attention. The possibility of just growth slowing across their brands. And then that shares could essentially have reached a peak. And look, they are up more than 20% year to date.
A real winner. I mean, as I'm looking at American Eagle Outfitters, had a terrible report. Abercrombie & Fitch and Gap have done a little better. I will note that Urban Outfitters also saying that the tariffs will be a slight headwind. They don't seem particularly overwhelmed by the tariffs at this time. All of this on the same day, while Lululemon is down as the leading loser on the S&P 500, down 17%.
I mean, Lululemon getting hit hard. They do have a lot of exposure to tariffs, as you mentioned there, and they tried to make some adjustments around that. But you remember, they'd started sourcing more inventory from Vietnam, and Vietnam being hit with more tariffs than they expected. So they have a lot of exposure there. And then obviously the price point is higher when you compare. I mean, it's still consumer facing, obviously, not necessarily apples to apples, because it's not necessarily athleisure.
We're going to go inside out on Lululemon in a moment.
Perfect.
Yeah, thank you for all of that.
You
Diane
got it.
King Hall, a good look at a lot of these names here.